Okay, so this second half of the lecture is all about risk. And this is the first time in the class that we're really going to talk about risk in any detail. And the reason why that's important is because of the second fundamental rule of finance, which is down here in red. And the second fundamental rule of finance says that risk and return trade off no matter the investment. And what that means is that there is no return without taking a risk. And the more risk you take, the more return you should demand, and vice versa. Right? So if you take no risk, then you should expect no return. Okay? So in finance, this trade-off is sort of absolute. If you take risk, you must demand return for it. Right? You don't take risk for free. Nothing is free in the financial world, and particularly risk. So if you expect or are promised a really high return, by definition, it is because you are taking a great deal of risk with your money. Right? So when we talked about junk bonds, they're now called high yield bonds. They're offering 20% interest on the loan. If you are making a loan and charging 20% interest, it must be because, this rule says it must be because the risk that you are taking by loaning that company money is great, right? The current market rate, you can get a house loan right now for under 3%, right? So if a company is offering 20% on their bonds, then that means that there is a huge chance that you will not get any of your money back, that they will completely default. Okay? So this risk-return trade-off is sort of central to our value of a bond or our value of anything. And it's central to our value because if we can come up with an understanding of risk and return, then we can determine the value of almost anything. Okay? So remember that the value of anything is the present value of its future cash flows. And one of the things that we haven't talked about at all in this class so far yet is what the appropriate rate of return is when we take present values. Remember, when we take a present value, we can jump all the way back to the formula. Central to both of those present value formulas is R, the required rate of return, or the discount rate. And we haven't talked about how to come up with that, right? In all of the problems that you've worked so far and the ones that you're going to be working for this chapter, I'm going to give you the discount rate. Okay? But the discount rate is determined by the amount of risk that the investment has. And so if we can determine this relationship between risk and return, and if we can model it in some way, then that is how we're going to be able to calculate the discount rate, the required rate of return, and ultimately we'll be able to come up with the best value. So we're not going to do that, okay, until after the second exam. So we're going to keep assuming a discount rate for a while, but that's what is important here, and that's what we're talking about. Okay, so that's where we're headed. Now, the reason why I like to introduce risk when we talk about bonds is because the risk of bonds are very straightforward. Okay, because a bond or a loan is a contract, the risks are listable in some sense. They're countable. Okay, we can talk about the risks because the risks are defined by the contract, and we can read the contract and know what that is. Okay? If we are talking about, say, the risk of a company, well, the risk of a company are uncountable, right? We don't know all of the risks that a company might face. They could run the gamut from a pandemic to a hurricane, to a tornado, to getting robbed, to a fraudulent accounting, to people just deciding they don't want to eat there anymore, or whatever, right? Like all kinds of risks exist for a company that we just couldn't potentially sit down and try to talk about what they all are. But for a contracted loan, those risks are much more straightforward. And so this is sort of the best way to start to talk about and get a feel for what risk in finance and economics actually means. Okay? So here I have the risks of bond investments, the major risks sort of listed in order of importance. And what we're going to start talking about, and we'll go into detail here, but we'll start talking about what we call the term structure. And the term structure is a collection of risks, the real risk, the interest rate risk, and the inflation risk, which we've sort of talked about in some ways in different places. Then we'll talk about what's called default risk, taxability risk, and market liquidity risk. Right? But ultimately, what we're after here is a way to define the relationship between the risk of making a loan and then the return that we should demand based on that risk. Okay? So I would want to be able to look at a company, identify the risks that are listed here. How likely is it the company is going to pay me back? What's the chance of inflation eating away at my income over time? What's the risk of taxes changing? Things like that's what all these risks are going to be. And what I'd like to be able to do is say, okay, these are all the risks. And if I want to be paid back for taking this risk, this is the coupon rate that you have to pay me. Okay? So I want to be able to define a relationship pretty specifically that will help me determine what the appropriate rate, the coupon rate that I should charge a company when I make them a loan. Right? This is how the market rate gets determined in aggregate, is that every investor in the market is sort of simultaneously thinking about all these risks. And that is sort of built into the market rate itself. And that is ultimately what companies use to determine their coupon rates. So this is basically how it works in practice. Okay? So let's start by talking about the term structure. And the term structure is sort of the most famous term when we're talking about risk in debt investing. Okay? And the term structure describes the sort of big three risks. The first one is called the real risk. The second one is called the inflation premium risk. And the third one is called the interest rate premium risk. That's not, premium risk is a bad way to say it. It is the risk premium, and it's a premium. The premium comes from the fact that the more risk you bear, the higher the premium you charge. Okay, so that's why it's called a premium. And you can notice that this is again determined by the time to maturity. So all of these risks are going to be greater the longer the maturity of the bond. Okay? And what we're doing here is we're adding, if we were going to be determining the nominal rate, what the coupon rate is going to be, we would add a premium depending on the risk of each of these factors until we got to the ultimate coupon rate that we'd be willing to charge it, right? Okay, so the term structure says that these three risks are going to play a big role in determining the coupon rate. Now, the real risk and the inflation premium risk are probably generally smaller than the interest rate risk, and we'll talk about why that is. Okay? But ultimately, what we'd say is that these risks are going to be additive. Okay, the premiums are additive, meaning we add them up to get our ultimate rate, and they are going to be increasing with maturity. And this actually plays out in practice. So you can look here. This is called the yield curve. It is the term structure of treasuries, U.S. treasuries. Okay, treasury is the name for a U.S. government bond. They're called a treasury. And they're issued in a number of different maturities, ranging from 1 month all the way to 30 years. Okay, so 1 month, 3 month, 6 month treasury bonds are usually called bills, treasury bills or T-bills. And then 1 year, 2 year, 3 year, 5 year, 7, 10, 20, and 30, those are typically called treasury bonds. And you can see that these are the interest rates, the yields that investors would earn if they bought one of these bonds in 2012 and 2013. And you can notice that early on, right? So 1 month is not early on. For bonds that have short maturities, 1 month, 3 month, 6 month, you can see that the yield is almost zero, right? So if you are going to loan the US government money for less than a year, even a year, you should not expect to be paid very much. And that is because the risk of loaning the US government money is quite low. In fact, we consider those bonds to be effectively risk-free, right? We sometimes call the treasury bill rate, the short-term treasury rate, the risk-free rate, because we consider the chance that the US government won't pay its debt over the next 6 months to be essentially zero. No chance that they won't pay their bills. Okay. Now, as the maturity of these bonds gets larger, the risk of anything gets larger. And so you can see that as we get out to, say, the 10-year or 20-year or 30-year, the rate on the 2012 bonds climbs to almost 3%, and the rate on the 2013 bonds climbs to almost 4%. And that's because even with a government as stable and with a history of paying its debt as long as the U.S. government, the risk of that being true for the next 30 years is still not insignificant. Right? And all the other risks that come into play, right? All these other risks are also true. Right? They also get larger with time. And so we'll talk about them in more detail, and you'll see why each one of these risks play out. But this is what we call the upward sloping yield curve, and this is what we expect, that yields get larger as the maturity of bonds increase. And that's because risk increases with time.